Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right, everyone. You are listening to Your Money Momentum podcast. My name is Tom Kennedy and Kevin Curley. Kevin, what's going on?
Just out here celebrating Argentina's election. Got a Milton Friedman disciple taking over a country with 140% inflation. I am fascinated to see what happens.
Yeah, maybe they can. He can take over our country too while they're at it. But yeah, it'll be interesting to see what's going on. There's a lot of political shift around the world taking place right now. So we'll see what happens next year with ours. End of the year podcast, or end of the month podcast. We're 2 days early, so a lot could happen in the next 2 days. So some of these stats and numbers might be off a little bit, but let's get into it.
Bringing you a look at the past month and what may come, here's the latest financial update.
So finished off a pretty good month. You want to walk us through some of the numbers?
Yeah, so Tom, since 1985, this is just outside of the top 10 best performances for the S&P 500 in quite a long time, almost 40 years of data. If it was able to get a couple more percent over the next 2 days, 48 hours or so, to beat the top 10, you got to be up 8.8 or about 8.5 for the month. The best month ever was January 1987, which was up 13.2%. I would also mention that I need one of the best months ever if I'm going to hit my 5,000 prediction, but it's definitely trended the right way. S&P up 20% for year to date. That's a pretty big move.
Well, the bull case for next year is the S&P 5000, so you would have the extreme bull case for this year. But it's not.
I'm pretty close, though. I mean, it might get there. And I laughed this week. All the big wirehouses, all the major investment firms put out their projections for next year, and they're all a year behind me saying 5,000 for end of 2024. But I don't know. I mean, this rally's got some legs. We get Santa Claus to deliver at the end of the year. We might be close to 5,000 by the end of this year, and I assume they'll all go back and revisit it. But their projections are silly because all they do every single year is 10% higher. That's the prediction. And that's why all those predictions from all those investment houses are the same, is they all look at it and go, 10% higher, great.
Well, we came off by one of the worst 3 months we strung together in a long time for returns in the market. So I think we were oversold. We were due for a bounce. We had the seasonality behind us. And I'll tell you, the correlation between the dollar and interest rates is back with the overall market. You have interest rates. You look at interest rates. Look at the 10-year Treasury off of 5% was the high. You're right around 4.4 right now. You have the dollar going down, and it's like clockwork. So you had a really, really good month. It looks like the S&P is going to finish up close to 10%, maybe 9%. Where are we at right now? You said 8.5?
8.5 as of today.
Yeah, we got 2 days.
Slightly up, kind of flat for today, but we're on our way.
NASDAQ, you have bonds performing. You have everything. Usually you have that inverse correlation with bonds and stocks, and you're seeing as interest rates go down, again, bond prices are going up and stocks are going up. So you have a lot of the portfolios are moving in the same direction. So I think hopefully you'll have that continue into year end and into December.
Yeah, I mean, this is just proof nobody has a crystal ball. If you look at the consensus from all the major investment firms last year, they predicted for 2023 that it was going to be the first negative year for equities. Like I said, almost every year, like clockwork, they predict a 10% increase. Last year, they all said it was negative, and here we are up 20%. So, it pays to stay in the market and not listen to people who are very negative or even people who are very positive. You have the NASDAQ up 37% after its worst year for a long time. All those companies got killed in 2022 and expected more of the same, and that just wasn't the case.
Yeah, I mean, you got the average of the top 10 growth stocks in the country right now up over 80%, which helps. So you still have, you still don't have a ton of breadth, but it's not. But stuff is performing. And I think what you're going to see, and what you always see in the month of December, you have mutual fund managers, pension funds. You have these big investment managers that are just behind. No one, to your point, was calling for what happened in the market. So it's not even FOMO. It's their bonuses. It's their bonuses. You're going to see window dressing, and what that means is you're going to see mutual funds, pension funds, big investment dollars chase one category. It's going to be tech. It's going to be tech. I think leads us into the rest of the year, and you're just going to see a tailwind, in my opinion, with these funds trying to lock in and try to get some last minute gains for the year, because a lot of them, whether they're hedge funds, pension funds, a lot of them are underperforming when you have the NASDAQ up 47%.
Yeah, it'd be hard not to. And I would say the other part is it's not just tech, though. The Dow Jones Industrial Average is 2% from all-time highs. Now, it's not having that great of a year compared to some of the other indices, but it's up 8.84%. NASDAQ, like we said, up 37, S&P up 500, or sorry, S&P 500 up 20. But to only be up just under 9% and 2% away from all-time highs for the industrial average is really tremendous. And it just doesn't feel like a recession. I still think that we're headed towards one. I think that it will happen. It's clear we had a higher rate of growth go to a much lower rate of growth. So there was, not negative growth because it didn't go negative, but like disinflation, we had growth or lower levels of growth. So it might feel like it a little bit, but the economy is starting to roll a little bit. The other thing people are so fearful, $5.7 trillion in money market accounts between retail and institutional customers. That's a lot of money on the sidelines that I think might be chasing the best month ever.
Yeah, you're absolutely right. That's the highest we've seen in a long time, and that money is gonna eventually have to go somewhere. It can't stay in money markets forever. I mean, it certainly can, but if you do see rates get cut next year, as those go down, they look less and less attractive. So you could see some extension to this run. But let's talk about this recession. Everyone's been calling for it this year, and there's great research that comes out that we subscribe to called the Sevens Report. They put something out every morning, and they make the case for the 4 pillars. And they don't make a bear case or bull case. They just say the foundation of this recession has 4 pillars to it. It's 1, earnings; 2, growth in the economy; 3, inflation; and 4, interest rates. Now, obviously, they're all tied and correlated to each other one way or the other, but those 4 are extremely important. All 4 of them you've had this Goldilocks scenario where you've had growth been pretty decent this year in the overall market. You're starting to see some cracks. You've had inflation going down, going in the right direction. We haven't really had any reversals or big spikes up. You've had the Fed. They've been pretty telegraphed. You knew they were going to continue to raise each time. They haven't had any major surprises at any meetings. They've had some hawkish forecasting and jawboning, but they haven't had any major, market's pricing in 25 basis points, but they go 50 or even higher. And then lastly, earnings. Earnings have been pretty resilient. Now, if one of those cracks and goes the other way, because this market's been priced into perfection, you could start to see some headwind. But in my opinion, I think it's going to be less and less. The story this year has been the inflation number. Every month it comes out, looking at that and what the Fed's going to do. I think it's fair to say that, or I'm predicting that inflation is probably going to continue to go down or flatline from here, and it's where we need it to be or close to it, right around 3%. Fed moving rates, the market's pricing in a 1% cut this time next year, and for I don't know if you saw Chris Waller this morning, one of the Fed presidents. He's was the first one to come out and say, hey, if inflation continues to go lower, we could see some cuts. And you had the odds of a cut go from 32% to 68% in May, the first cut being in May at 68%. So I think those 2 are going to be less important going forward. And I think it's going to be about growth in the economy.
Yeah, I want to follow up on 2 things you said, which is 1, the Goldilocks scenario. So I think Goldilocks for markets this year is, interest rates look like they may have peaked in the last couple months. They're now declining. We had a 2-month low on the 10-year Treasury, just below 4.4. That's really a nice tailwind from where we were. Earnings have not fallen off. Growth hasn't been as strong, but it's still positive. So, and inflation's coming down. So I think you could see that Goldilocks scenario continue for sure. The other thing you mentioned, which I think can be confusing when you hear it on TV or you hear it on a podcast like this one, which is that stocks are priced to perfection. So do you want to jump in and just say what that means and why it's a concern and not a good thing?
Yeah, so when I say they're priced at value is what I should say. Now they can go over value, but when you have earnings come in, you have PEs valuations around 19, and you have projected earnings next year of 245 a share, you're right around where we're at right now, maybe 2% higher. So a lot of the data, especially the when it comes to the fixed income market and the Fed, it reacts quickly. And all this good data has been priced in. So the minute if inflation comes back out and it goes the other way, you could trigger a little sell off. Or if the Fed goes the other way and says no, we're hiking rates. Those two things are not priced in, and I think you'll get a sell-off in the market. So I don't know where you're going to see much more positive data unless you start to see earnings projections for next year start to pick up, and rates decline, and growth does not fall off a cliff. I think that's going to be the biggest determinant for the next 12 months if we get the soft landing or hard landing is growth in the economy. The consumer balance sheet's you're starting to see delinquencies pick up. I know we continue to talk about that. It's nothing crazy. Does the corporate side start to get hit with earnings? I think that's just going to be the big, we don't know. You're starting to see a little bit of cracks here and there with some of the data, but I think growth's going to be the new story. Does this
Let's
high
talk about that growth story. So I would mention one last piece of data, which is just the VIX is hitting a multi-year low right now, down at a 12. So that's a pretty complacent market. Usually that's a sign of things are getting pretty good, like Goldilocks continues to be trying out all those different porches. But to the growth conversation, I think that you're seeing across the world right now, we talked about it in a previous episode with Europe, with its fiscal deficits attacking them versus the U.S. not. This morning, the Wall Street Journal said that global sovereign debt interest payments are expected to top $2 trillion. Now, I'm personally not a Keynesian guy, but most of the academics and economics people in the government are, and they think that government spending is a major factor in the economy, and it can kind of drive or whatever. So if you have $2 trillion in interest payments and you continue to borrow, it keeps going higher, at some point you have to cut government spending or raise taxes to meet that problem. That should be, based on a Keynesian model, a major decline in growth.
Yeah, that's such a good point. And we talk about just the interest payment that the U.S. had alone last month was 78 billion.
As big as the defense budget.
78 billion.
For interest.
So let's put that in perspective. That's 900 billion annualized just in interest payments. Do you know what TARP was in 2008 to bail out the banks? It was 700 billion is what they proposed, and they thought they were absolutely crazy.
That was pre-inflation, Tom. That was pre-inflation. These numbers don't equalize.
But just to put it in perspective, it's like just the interest alone will bankrupt us. And I think, to your point, the big question is, someone said it the other day, they phrased it really well, is are they going to cut rates because they have to cut rates or because they just can cut rates? Two big differences. If they have to cut rates, that means the economy is cracking, we're going into recession, and the only tool they have in the bag is to lower interest rates, and they're pretty high right now, and I think you'll see them drop pretty quickly. If they don't have to, but they think that they should, that's the soft landing scenario, which we've never had before, by the way. So, but I think we have a massive sovereign debt crisis. And by the way, just 2.5 years ago, you had, I think it was at the peak, $17 trillion in sovereign debt with the negative yields. And that's completely flip-flopped. And now, to your point, $2 trillion in interest rate payments just to service that debt.
Yeah, look, it's a controversial figure, but it wasn't a controversial policy when Trump suggested the U.S. should issue 100-year notes or bonds, I guess. I don't even know if you call them bonds at that point. You'd have to call them super bonds or something else ridiculous. But he said, look, interest rates are zero. We should issue 100-year notes and refinance all our debt. That looks like a pretty good idea right now. And it's something people can take to their personal lives too, which is right now is not a great time to borrow money. But if the Fed does drop rates, let's say it's 2.5% over the next 12 months, it's a chance for you to look at all your own debts and say, how do I consolidate these? How do I reduce these to pay a lot less interest so you don't end up like the U.S. government, which is at some point going to run out of money. You just can't spend like this indefinitely and cut taxes. So,
Yeah, you'd have to have massive austerity, and it's just and the challenge. I know we've talked about this before. It's whether you're the left or the right, it's political suicide. No one wants to do either of those, and it's really probably the only, at the end of the day, the only real way to tackle this debt. But I think they are going to be forced to cut rates for that reason alone. It's snowballing. It's absolutely snowballing.
Yeah. Well, this morning we got more data on the housing. Another positive month for housing, up again. And now this data is from September, so it's a little bit old, but 7 months in a row where the prices are going higher. So, Tom, tell me why I don't just own all real estate. All it does is go up.
It's true. It does. Except 2008.
Everybody who owns a commercial building right now, what their prices are doing.
No, it's one. I'm a huge advocate of real estate. There's different ways to own it, like we've talked about. Everyone's in a different investment profile, situation, etc. But housing. You're right. It continues to go up, which is just crazy based on where rates are at. But it comes down to supply and demand, and there's no supply out there because no one's trading in their mortgage, and builders aren't building because it costs too much to carry the cost to build with interest rates so high. So you're in this weird, like, limbo where you don't have the supply being put out there. The demand is kind of staying stagnant. It could even be the demand could possibly be even falling. It's just that there's so little supply that it's keeping prices elevated. So now you mentioned commercial; those are two different animals, retail and commercial, but they're all doing well. I mean, COVID is over. I don't know if you're starting to hear more companies do the go back to the office and not doing the hotel model as much, and maybe forcing employees. So maybe office rebounds a little bit more than we thought, which will help commercial real estate. But it's tough on the real estate side. I don't know what to think of it because the numbers don't lie, and you're right, they continue just to go up every month.
Yeah, I think the only place that's been hurting really this year is probably the oil market and commodities generally, which was a hot spot to be for a little while, but down 5.8% year to date for the Bloomberg Commodity Index. Gold doing fine outside of that, but you've seen utilities fall off as a sector. Energy is basically flat. It kind of seems like the end of the cycle to me.
Well, it's
When
just
those things start to roll over, that's kind of it, right?
yeah, or it's just the calm before the storm. I think I don't know what's going to come out of left field. I don't know what skeletons are still out there. We had the banking crisis in March that looked pretty scary, but with interest rates going to 5 last month, you think that some would reappear, and we didn't see it. I don't know what the next crisis is that's going to happen, but I think I'll keep your eye on the growth number in the economy, because having rates this high this quickly, it lags. It's going to take time to truly have an effect, and it might not be as much of an effect that we thought. Maybe we could stomach these higher rates. Maybe they are just so low that maybe this is the normal. I don't think it is, but I think any type of crack in growth, GDP, could really start to have an effect.
All right, Tom. Well, that's all I've got. Should we move on to some bold predictions?
Let's do it.
Get your future freezing cold takes as we launch into our latest series of Bold Predictions.
So why don't we do this? Well, we got December. What's the market going to do in December?
We're going higher. I think I'm
That's
going to
it?
stick with my $5,000 target on the S&P 500. Look, it's trending that way. Like I said, volatility's down, interest rates continue to decline. We got some companies reporting earnings right now, but it's kind of the end of the earnings cycle. So everybody's going to be gearing up for next year. And you just heard all the investment houses say, hey, get ready for 10% gains next year. If you think that, you want to get ahead of it. So I think we'll get a nice rally, especially Santa's going to come to, what is it, Broad and Wall?
So that's a 10% move from where we're at right now, which it's happened before.
Trying to
in
crack the best
December.
month ever. So we'll see. Maybe it'll happen the first week of January, but I think it's positive. I think it's trending in the right direction. My bold prediction for the next 12 months is that the Fed is going to do what it always does, which is overshoot. It's going to take the stairs on the way up, like they've done hiking. Now, they took some pretty steep stairs in this cycle, but they're going to take the elevator shaft down. I think they cut 2.5 points between now and next December.
Yeah, you stole my bold prediction. I want to disagree with you. So I want to disagree
Glad I
with you
jumped in
so
there.
bad.
Hey, go stronger. Say they're going to cut 100 or 500 all the way back down to 0.
Listen, like I said, I'll continue to say this every podcast. December 2021, they predicted at the end of 2022 that we were going to be at 0.85% on the Fed funds rate, and we were at 4%. So they got it real wrong on the way up. They're definitely going to get it wrong on the way down. And typically, what you've seen in the past is when they cut rates, it goes really quick. But that's because they always have to. There's something wrong with the economy and they have to drop it. So if you go through this scenario that's never happened before, we've had the soft landing and they're just going to cut rates because they can, could be a different story. But if they have to cut rates because they have to, I mean, you could see 2.5, 3% come off real quick. But
yeah, I think you see the data in that way.
Yeah, I mean, you got the market pricing in this time next year, a full 1% lower. And like I said, you just had Chris Waller speak this morning. First kind of Fed official to come out and say, hey, if the inflation's lower, I don't see why we need to keep rates this high. And you literally saw the odds in May of a rate cut go from 32 to 68%, which was a pretty big jump. So either they see something that we don't, or maybe they're just in this, maybe they just have this scenario where they have the luxury to say, hey, maybe we should just cut rates. But hasn't happened before. We'll see if it happens this time around.
Yeah, the last bold prediction I'd have is that the recession that we keep expecting to happen might get delayed. And that would also go along with the Fed cuts, or maybe it won't. Maybe they'll cut to prevent it. But I think that there's a lot of people up for election in 2024, and none of them want to lose their jobs. And I think that they might do something from a government standpoint to try to delay the recession until the day after the election. We saw this first done by Richard Nixon. He won in a landslide, and minutes, hours, days later, the economy just started to collapse. And it was a real simple thing. He did everything he could to press every level possible to make sure he got reelected, because he knew if it was in a recession on, we'll call it November 1st, he's done. But if he could last until mid-November, he could get reelected, and he had 4 years to figure it out.
Yeah, I wouldn't disagree with you on that, which sets up for a really, really scary 2025. But hey, that's so far away. Let's just take the good as it comes. All right.
All right. Thanks, Tom.
That's a wrap. We'll catch back up at our mid-month. Thanks, Kevin.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.